Okay, here we go with another book. This one is How to Build Wealth. This is written by Bill Poulos, who is one of the co-owners of Profits Run, which is here at the bottom. Profits Run is the company that these two gentlemen started, father and son. And it's basically an investment strategy system that you can purchase and be a part of, and it's a community that you can glean information on how to trade stocks and hot stocks and all that type of stuff. And he, this book is basically doing exactly what Gary Vaynerchuk's book, Jab, 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 Right Hook, encourages people to do, which is to give, then ask, right? And so he's giving you a whole bunch of strategy and kind of upfront knowledge on stocks and investing and the types of investments there are. And he goes through a whole bunch of good information in this book. And then, of course, if you want more and you want his strategy and you want weekly and monthly feedback and a community to talk to and learn from, then you can buy into his program. So I thought it was a very generous book as far as giving good information to a beginner. And he's got a good strategy, in my opinion. As from, I'm someone who has traded stocks most of my life, starting at a really young age. I really got crazy about the stock market in my early teens. My grandfather had purchased a small amount of stock when I was about 8 years old. And then by my teens, it had turned into a significant amount of money for a young kid. And then I think he started me out with like $1,000. So it had more than doubled several times, and it had turned into a good investment, and that really piqued my interest in, like, this is crazy, like I can make so much money this way. So I got nuts about the stock market. In my early teens, I would ask for stock for like my birthday and for Christmas and things. I would want stocks. And then I went on a religious mission down to Argentina for 2 years, and I doubled my money over those 2 years. And so I came back a fanatic as well. And I kind of, in my experience, I went through multiple phases of how I would trade stocks. So in the beginning, of course, that was long-term investing. My grandpa bought me some stock in a bank, and the bank did well. And over the course of 7 years or whatever, it really had done well. And then I started moving stocks a bit, and I got my own like Scott trade account so I could do, discount trading and things. I started moving it a little bit more. I started buying, like, for example, I started experimenting with stocks that were paying monthly dividends. So for the beginner out there, certain stocks will pay a cash dividend. Usually it's quarterly or semi-annually. Sometimes it's annually and sometimes it's monthly, which are the ones that I like the most, because there's one big reason I like that. Because the stock market is extremely emotional. People are crazy about the market and their money, right? And they should be, taking thought and thinking about their money and have some hesitancies when necessary about their money, right? But because it's, people typically overinvest and are undereducated, it makes it even that much more emotional. It's scary because it's like, I don't even know. It feels more like going to Vegas and throwing your money on the craps table. And so it's like, it's really scary for a lot of people. And so you got to remember that the stock market's super emotional. And for me, it was that way too when I was young. And so when I started getting in dividend stocks that paid monthly, specifically monthly, it took some of the emotion out. Like, I was able to just like relax and let my stocks be. Like, I got in some good investments according to everything that I know, and I'm getting paid every month. And so then I can take whatever extra money I'm putting in plus the dividends, and I can play with that money, and I can invest here and there, and I can, and so I always had this it was almost like a calmer, like, okay, like the money's going to keep coming in and I can buy more stock next month. I went through a phase of day trading. Shortly after I got home from my mission, I was 22 years old or 21 years old. I had tens of thousands of dollars, and I was just gambling, literally, like on the stock market. So I would look at trends. Now, I wasn't too far off. A lot of the advice that he gives here is what I was doing, exactly what I was trying to do. Now, maybe my methods weren't good and I didn't have a solid plan like he explains is super important. But basically what I was doing, one piece of advice that I had already heard and he gives is that, like, don't get too greedy. You're never going to catch the exact bottom of a stock's drop, and you're never going to sell right at the peak. But, you know, if you can catch it on the upswing, and then once it peaks and starts coming down, sell before it drops too far. You essentially catch that middle third of a wave. And if you can catch that middle third over and over and over, you're going to continually make money. You're going to do well. So I was essentially trying to do that. My biggest problem is I didn't have good exit strategies. And he goes over that in this book. But so I was 21 years old, and I remember waking up one morning and I had made $2,800 by like 8:30 in the morning, and I'm sitting in my apartment, like I'm about to go to class in college, and I just made $2,800. I'm like, what's the point of going to business school when I'm doing great, right? And then, of course, over the next few days, I would win some here and lose some here and whatever, and essentially that $28 was reduced to, maybe $500 over the course of the week. So then I wasn't making that great of money. And then you take into the account all the expenses of trading. So with Scott Trade, it was $7 per trade. So every time I buy, $7. Every time I sell, $7. So if you're buying and selling multiple trades in one day, you're burning up, like $50 a day. And then, you're getting big wins and big losses. It was just chaos. And some weeks I would make negative, I would lose money, and some weeks I would make good money, and it was just nuts. But I learned a lot. And the thing with the day trading is it was extremely vulnerable and emotional. And that's where stocks, that's where you lose in stocks, in trading any market, not just stocks. I just refer to the whole entire investment market as stocks, but there's different areas. But trading the markets, you lose if you are emotional, and he backs that up in this book too. He says that young traders or amateur traders expect success right away, and their emotions they'll cause them to invest before the investment was right, or to pull out before they should have, or instead of sticking to their exit strategy, they'll change it because the stock dropped, and they're like, no, but this is a good investment and I need to make money. And so they won't sell and just take their losses and run. Instead, they'll just ride a stock as it drops, and then their money's tied up in a bad investment. And so amateurs do this kind of stuff because they're so set on winning every time or becoming a millionaire now. And you can't do that. You've got to get control of your emotions in it. So one book that helped me was the Warren Buffett way. Now, if you don't know Warren Buffett, he became a multi-billionaire. Today, he's worth, depending on the day, somewhere between 50 and nearly $70 billion. And he did it by investing. He was just very middle class, but he was dedicated to it. He found a method that worked for him, and he's smart. So one of my favorite quotes from his business partner, Charlie Munger, he said something along the lines of, it takes character to sit here with all this money and do nothing. Because Charlie Munger and Warren Buffett don't just invest every dime they have the slightest opportunity that they see. They are very careful about their investments. They'll look at thousands of companies and they'll just look at the numbers and use their method and look at the numbers. And when they find a company that they think is a good investment, of course, it has to do with profit, right? That's the main indicator that drives the entire market trading, is how much profit's being made. And then secondly, for Warren Buffett, does it have a moat around it? Like, one of his biggest investments of all time was in Coca-Cola. Well, Coca-Cola has stood the test of time. Like, the only real competitor was ever Pepsi, and Pepsi's never had the marketing or the branding and that Coke has. Nobody's been able to really take much of Coca-Cola's market, and they've been around for like over 100 years. So they've gone through the Great Depression, they've gone through millions of competitors, they've sponsored the Olympics, they've gone to every country. So essentially Coca-Cola is just getting bigger and bigger. The soft drink industry has just gone bigger year after year. So when they decided to buy, they bought every share they could get for an entire month. They ended up with approximately 8% of the company. And then they held on to it for like 40 years or more. And I think they still own it. I'm not sure. But over 40 years, that investment became a multi-billion-dollar investment for those two. So the Warren Buffett way is different than what I was doing, obviously. And it's less emotional because you're sure about the investment you're going to make. Now, one thing that I did not start doing early enough that he reinforces in this book that I really like is your exit strategy. Now, if you're going to do the Warren Buffett way, right, and you're going to buy a company you think is good and you're going to ride it, that's awesome. But what if 2008 happens again and the entire stock market just crashes, even though a lot of these companies are really good? We don't want to ride that all the way to the bottom and then ride it all the way back up over, a few years. And in the meantime, all that money has just been tied up in a poor investment. Or, even if the company's good, it's still dropped in its price and your money is devalued and all that. So one thing that he does that I totally endorse is putting trailing stops on your stock investments. So if you don't know what a trailer is, you can say a stock is currently selling for $10 a share today. You can put a trailing stop for, I think the minimum is $1. So say you've analyzed the stock and it never really drops more than $1 over the last couple years or whatever. So you're going to say, okay, I'm going to put a $2 trailer. That means that right now it's going to sell at $8 if it tanks. But as that stock price increases, so does your trailer. It just always stays $2 behind. So if it ever, hits a new high at $12, well, now your new trailer is set at 10. So if it ever tanked, you would sell your shares at 10. And so, it just keeps going. The only reason I am a big fan of that is I rode the stock market down in 2008. I made a big mistake and I lost tons of money. Had I had these trailers in place while the market was crashing, my stocks all would have sold far before it was I was in the hole, and I could have just waited. I could have just said, okay, things are chaos right now. I'm just going to keep my money out for a minute and see what happens. And then, of course, once it started really turning up and it looked like it was back on track for some recovery, I could have bought in again, put my trailers in place, and let it ride to the top. And I missed out on literally hundreds of thousands of dollars because of that mistake. Now, I didn't lose hundreds of thousands. I didn't have that kind of money, but I did lose tens of thousands, and I missed out on hundreds of thousands had I used that method. Obviously, hindsight trading is way easier than trading the futures, right? But these methods can prevent those types of mistakes. Even if you get in a bad investment, you sell, you might take a small loss, but you don't take that huge loss and lose all your trading money. So I'm finally going to get to the book. A long book review, How to Build Wealth by Bill Poulos. So first thing, he says, if a trading strategy is too complicated, you won't follow it properly, which will lead to mistakes, which ultimately leads to losing trades. Simple is better. That I found out in my experience. I used to analyze every number I could find. I'd look at all the information that's given there. I would go digging online and try and look up the CEO, find out who he is. Does he have a good history in other companies? Like, what's the news in the industry? All this stuff. Like, after a while, like, you don't even know what you're comparing to. Like, if you keep digging, and then go to its competitor and dig, and then its competitor and dig. Like, after a while, it's all just muddled, and you're back to just gambling. Like, there's too much out there for you to try and dig up. Get a simple method, a handful of indicators that are all correlated and things that are true market indicators. So, for example, profits drive the stock market. When a company's quarterly earnings come out, if they've hit or exceeded their profit goal, the stock price goes up. Almost 100% of the time. If they do not hit their price goal, the stock price drops. I mean, that's one of the huge indicators that drives the entire stock market. So grab a few indicators like that and learn to analyze them quickly, and just stick to your guns. Amateurs expect to strike it rich almost immediately, and they get frustrated if everything doesn't go their way. For example, in trading, amateurs expect to win every trade, or they expect to make money every week, and if their expectations aren't met, they mistakenly conclude that their approach is invalid, and they give up and go on the hunt for another get-rich-quick scheme. This is why amateurs remain poor, because poor think in weeks. And then he goes on and explains different. Middle class, on the other hand, think in months. Rich think in years. They think more about investments, financial education, buildings, businesses, and multiple streams of income. And the wealthy, they think in decades. They think about asset protection, how to minimize their taxes, how to best have their money work for them, how to create and grow charities, and how to establish a legacy for their children and futures. I thought that was really interesting, and I've gone through those phases in my life. I think I would be more in the area of I think in years. I moved on from the day trading. I am more in the Warren Buffett way, but I still am like, gosh, I want more money now, like quickly, right? So it's tough to hold back your emotions and sit back and let it all work for you and let your plan go. He says, another trait that wealthy people possess is that they take responsibility for their own success and failures. They never blame others. Wealthy people constantly invest in bettering themselves by reading books, attending seminars, and working with coaches. Finally, wealthy people also have an abundance mentality. They tend to be some of the most generous people on the planet, openly sharing their time, knowledge, and money with others, not in the expectation of getting something back, but for the sake of paying it forward. You got to have an abundance mentality, and I hear that from every major like success speaker talks about, like, get out of the scarcity mentality and find your abundance and mentality. Like, think in abundance, share with people, look for opportunities to give. Like, don't worry so much about losing a little money. You're gonna make it back. Like, in fact, sometimes it's good for people to like lose something major. Like that 2008 crash that I lost tons of money. Like, I lost a big portion of my portfolio in 2008. Not all just because of the crash. One of them was I sold a really good stock, buying one that I knew was going to split because it was an airline industry, which I don't even invest in airlines anymore, but it's an airline industry adding a plane a week, all these flights going on. It had all this great stuff. The stock price was going up, and I had heard that it was about to split. I sold this great investment, bought that one. It split. The stock price shot up, and dropped back down way below where it was before, I lost about $10,000, and it never really recovered for like years. So I ended up selling, a year down the road, tied up all that money in a bad investment. And then I bought a bunch of other stuff, and then 2008 happened. I mean, I lost so much money over that time. And here's the thing, it was gut-wrenching. It hurt for a minute. And then I got over it. Like, life goes on. I still make money. I still have a good life. I still have a great family. I have all the important things. I'm comfortable and well, and I've had plenty of good jobs and health and all this stuff. So, like, don't get too worried about it. Like, I learned a lot from taking the risks and just getting involved, right? Like, you'll never become a good real estate agent or real estate owner if you never buy a piece of real estate. You have to get in, and you're going to make a mistake. Like, obviously try not to, but don't worry too much about it. Beginner traders tend to use far too many technical indicators, which can create analysis paralysis and hopeless confusion. In fact, the more indicators that you apply to your analysis, the less likely such analysis will be helpful. But remember Einstein, simple is indeed better, especially here, because all you really need are a handful of indicators that complement each other and that are simple to interpret. I'm totally down with that. Let me just tell you how simple it's gotten for me in a lot of my investments. Half the time I don't even look at the industry the company's in until I've found some good charts. I'll just look at graphs. How much growth has this company had this month, this year, and the last 5 years? Does it have a good track record? Is it outperforming other stocks? Does it continually go up? I don't like stocks that go like this, and then they go like that, and then they're like this, like year to year. You don't know where it's going to be. But over 5 years, it just goes up every year, month after month, year after year. When I find those, I go, here's a good investment. I find a handful of those, look at the dividends. I look, does it pay any, when, how frequently, like what percentage, and then I start looking at like industry. Okay, is this industry something that I personally want to buy into? Is this something that I think it has a future in the way that the economy is and the electronics are changing and the job changes are happening? Is this an industry that I personally believe in? If yes, I buy. That's essentially how I do it. And I've had more success and far fewer losing trades doing that than I ever did breaking down the whole company and finding out the leadership and doing my analysis as deep and as well as I could, and spending just hours and hours poring over these things. I've had more success with this simple plan, looking at the track records of charts, essentially, buying into those industries I believe in, and then putting my trailers so I never take a big loss. That's my method. That's how simple it's gotten for me. So I totally believe in that. Like, I know that gurus on Wall Street know way more than me, and they might argue with that and whatever. I'm just saying that's what I do, and I've had great success with it. I've made double-digit returns on my money every year in the stock market, with the exception of those early years when I was really doing day trading and moving my money around a lot, and like I said, pulling out of one good investment to try and hit that peak, those kind of things. I've had bad success doing those, and I've had great success with my new method. It's not new, my method. I've found that the sweet spot, this is his thing, I found that the sweet spot time frame that gives you the best return for the actual time you spend managing trades is either swing trading or position trading. Definitely some form of end of day trading where you only need to place and adjust your trades after the market closes, usually in 10 minutes or less. So he's talking about catching that middle third of waves. I haven't gone into enough detail of what he's talking about in his book to make a lot of sense, but basically he's saying you find stocks that have upward trends and waves of up and down, and you're trying to get that middle third over and over and over on its way up. Now, the reason he does this is because his method works in a good market or a bad market or a flat market. See, most of my method works in good markets because there's a lot of good stocks that are going up. I'm just going to buy and hold on, and I'm going to put my trailer in to protect my downside, and I'm just going to step back, right? He is saying, like, even in a bad market, you could short sell stocks the same way, right? So if a stock is trending down, short sell it. Now, that's a whole other thing. I'm not going to go into short sells, but basically you're betting against the stock going up. You're betting it's going to go down. So essentially you're borrowing the stock and then selling it back. And it can be confusing, but it's pretty simple to do. It's a kind of a confusing concept, but basically in using his method, you can make money on a down market. You can make money on a flat market because you're just trying to catch that 1/3 over and over and over. Using this method, you're going to have a lot more losses, but you're also going to have a bunch of wins. So you got to stick to your guns and practice it. But I like the fact that, you know, you can trade it in 10 minutes a day after the stock market's already closed. Go do your quick analysis, check your stocks, see what your prices are that you need to set them, and then adios. Tomorrow it'll buy or sell or whatever, you know, without you watching. Why people lose money? People lose because they don't have a good trading method. Very true. I've gone through all that. Number 2, people lose because they become impatient and force trades. This has been my biggest downfall over the years. Is like, I got all this money. Remember Charlie Munger, it takes character to sit here with all this money and do nothing. Got all this money burning a hole in my pocket. I want to turn it into, I want to double it. Turn 10,000 into 100,000 today, right? It's like, if I don't get in now, I'll miss out. Well, maybe the market's not right for you. Maybe you haven't found the right trade. Like, don't force a trade. This stock looks like it's got that good upward trend and the wave's going on. Don't buy up here and then ride the wave down and back up, like if you're using his method, right? Because that, I mean, you're putting days or weeks on a trade that you could have just waited for 2 more days, caught the upswing, sold it on the downswing, caught your metal third. So he says, don't force trades, be patient. A good trading method will keep you out of the market when it's too dangerous to trade and when the odds are against your success, but most people feel like they're missing out on something if they're not in the market. This is when they'll force a trade by ignoring their method and just going for it. People lose because they let their emotions become the basis of their trading decisions. I cannot emphasize that enough. People lose because they go with the crowd. Friend says that this is a good stock, jump in. People lose because they have unrealistic expectations, definitely, especially new traders. And then he goes into his method in more detail, which I think this book is worth reading if you're interested in it. But as a trader, you're looking for a market that moves up and down in a smooth, even fashion. That's kind of the basis of his trading. So the last thing I'll say, since this video is getting super long, everyone is using the same. So this, I thought this applied good to other things, not just the market. But if everyone is using the same indicators in the same way, then none of us have an edge. Instead, the key is to use a few technical indicators in an uncommon way. That's how you get an edge over the traders. That's how you get an edge in anything. Like, use the same methods, the same technology, the same strategies in an uncommon way. And then, you know, that's how you have success in any industry, in trading or whatever. Like, take this concept that's working and then find a unique way to shake up the market, to shake up something, right? People don't like the same thing over and over. They're not going to just jump on board. They want something that's similar enough that it's familiar, but like unique enough that it catches their attention and they remember it and they want to be a part of it. So find a few indicators, try and use them in an uncommon way that's just slightly out of the, you know, the bell curve, and you kind of create a new market on the fringe. So anyway, I thought this was a good book for a basic stock market investment strategy for someone who's interested in getting into it but has not yet found their niche or their the right information. By the way, he goes through all the different markets, like the stock markets, ETFs, mutual funds, bonds, different things, different markets that you can trade in, the foreign markets and things like that. And so there's different ways and markets that you can use, but his strategies work in pretty much all of them. So anyway, go check this book out. I'll put a link below so you can purchase from Amazon, and go to the website bronsonwilks.com to see what other books I've reviewed, and check out the other resources there. So thanks for watching.